Man, these markets, huh? Feels like you're on a roller coaster, blindfolded, and going through a car wash all at the same time.
Yeah, definitely a lot to unpack with everything happening.
And that's exactly why we are diving deep into Bill Cara's Global Markets Navigator report, hashtag 13 this week.
Smart move. He always seems to have his finger on the pulse, especially now.
Right. And you know what's really cool? Bill actually made this week's report free for
I
everyone.
saw that. I think he knows folks are struggling to make sense of things right now.
Definitely sends a message that he's not just in it for the subscribers, wants to help people understand what's going on,
For sure.
which is really needed because, well, let's be honest, this report paints a pretty stark picture.
Yeah, no sugarcoating here.
So for this deep dive, we're going to try to really break down the biggest, most important themes that keep popping up.
Sounds good.
For me, it's definitely the whole global tariffs situation, and of course, how everyone's feeling emotionally about the market right now.
Makes sense.
Then, of course, we got to cover Bill's conclusions, any actions he suggests taking, and where he sees potential opportunities.
Yeah, like those investment areas he highlights.
Exactly. Plus, got to give Bill props for making this report accessible to everybody.
Absolutely. Generous move in these wild times.
So, jumping right in, one thing that just screams out from this report is the sheer impact of those tariffs the U.S. slapped on Canada, Mexico, and China. Remember back on March 4th?
Oh, yeah. Those definitely sent shockwave.
Big time. And Bill directly links them to the S&P 500 taking a nosedive on March 10th.
No surprise there. Tariffs create uncertainty, and markets hate uncertainty.
Which leads to another big theme, that whole risk-off sentiment Bill keeps talking about.
Right.
But for folks who maybe aren't super deep in the financial weeds, what does that actually mean, like day to day? What does risk-off look like?
Okay, so imagine it like this. Risk off is basically when investors get all nervous and start prioritizing protecting their money rather than, going for those big risky wins.
Makes sense. So it's less about growth, more about not losing what you have.
Exactly. It's all fueled by negativity, fear, that whole hunker down mentality. And you can see it in how people are moving their money. They're pulling out of assets that are considered riskier, like stocks, even crypto, and flocking towards things that seem safer.
Like those U.S. Treasury bonds and German bonds Bill mentioned.
Exactly. It's a classic flight to safety.
Okay, so that makes sense. But what's fueling this risk-off mood right now? Why are people so spooked?
I think a huge part of it is the rising fear of a recession, like a legitimate economic downturn.
Yeah, makes sense.
And the report points out how these fears are actually shaping different corners of the market. Like, remember how U.S. Treasury yields dipped on March 21st?
Yeah.
That was a direct result of these concerns. Plus, we're seeing corporate bond spreads widening too.
Which, to be honest, I always have to look up what that means exactly. Can you break it down in, like, regular person terms?
Sure. Think of it like this. A bond spread is basically the extra interest investors demand to hold on to a riskier company's debt compared to, say, rock-solid government debt.
Okay, so like a risk premium.
Exactly. When that spread widens, it's a big flashing sign that investors are getting more and more worried about those companies actually being able to pay back what they owe.
Makes sense.
So yeah, bond markets are reflecting this fear. But it's not just them. Even central banks are getting in on the action, and their moves are pretty telling.
Oh, yeah. Like the Bank of Canada slashing rates on March 12th,
Yeah.
and the ECB doing the same just a few days earlier.
Yep, exactly those. And the report specifically mentions how the Bank of Canada straight up cited trade conflict anxieties as a major factor in their decision.
So they're basically saying, hey, this trade war stuff, it's got us worried too.
Pretty much. It's like they're acknowledging that these tariffs, they're not just some abstract political game. They have real-world consequences.
Right. And that brings us to another point Bill keeps hammering. How incredibly vulnerable our globalized system is to these sorts of trade barriers. Like, we're all connected, and when one part gets squeezed...
The whole thing feels it. It's like a domino effect.
Exactly. And the report highlights the U.S. reliance on foreign savings as a major pressure point.
Yeah, I mean, the U.S. depends heavily on capital flowing in from countries like China and Mexico. It's how they finance a good chunk of their spending and debt.
So when you throw tariffs into the mix, suddenly that flow gets disrupted, right?
Right. And then you've got this whole Pandora's box of potential fallout. Bill talks about countries potentially retaliating by, say, devaluing their currencies.
Which would, like, make their goods cheaper compared to U.S. goods, right?
Exactly. It's a way to offset the impact of those tariffs.
Hmm.
Or they might just cut back on how much they invest in U.S. Treasury bonds.
Uh-oh.
Yeah, either scenario could create some serious instability in the financial system.
So basically, messing with tariffs is like playing with fire.
Pretty much. And it's important to remember that Bill isn't talking about just any old tariffs. He makes a clear distinction between what he calls punitive tariffs and regular customs duties.
Okay, yeah. What's the difference? Because to be honest, tariffs always just sound like, well, tariffs to me.
Fair enough.
Mhm.
So think of customs duties as like your everyday taxes on imported stuff. They're pretty standard. Punitive tariffs, though, they're different. They're deliberately set super high, and they have very specific goals, usually political or economic.
So they're more about sending a message than just raising revenue.
Right. And the report lays out a few reasons why a country might use them. Protecting certain industries within their own borders, retaliating against trade practices they see as unfair, or even using them as leverage to force negotiations.
Like those tariffs on Mexico that Bill mentioned, specifically in the context of, the whole immigration debate.
Exactly. So it's not just about economics. It can get tangled up in all sorts of complex political issues.
Okay, so we've got these big looming tariffs, and they're causing a whole lot of anxiety. Let's dig a little deeper into what Bill says about their impact, especially on a global scale.
Sure. Well, he gets pretty specific, actually, breaking down those U.S. tariffs on Canada, Mexico, and China that were announced on March 4th.
Right.
And the potential consequences he outlines are, well, not pretty. We're talking about the very real possibility of higher inflation.
Meaning everyday things get more expensive.
Right, because those imported goods suddenly cost more. Then you've got the potential for unemployment to rise as businesses grapple with these higher costs and their supply chains get all messed up.
Not to mention the risk of capital flight, right?
Oh, yeah, that's a big one. That's basically when investors start pulling their money out of a country because they're spooked about the economic outlook.
Like rats fleeing a sinking ship.
Kind of.
Yeah.
And Bill's ultimate point here is that these tariffs, at the end of the day, will end up costing both U.S. households and businesses a lot of money.
And he really drives home the point that these tariffs, they're basically a tax on the consumer.
Yeah, that's a key takeaway. Plus, they throw a major wrench in the smooth operation of global supply chains.
And we're already seeing some very real-world examples of this impact. Like, the report talks about how lumber prices have taken a hit because of the tariffs.
Right, and then you've got U.S. soybean prices dropping because of China's retaliatory tariffs.
It really brings home how these abstract trade policies can have such tangible effects on everyday goods.
Exactly. And the ripple effects go even further. Bill also talks about how these tariffs on imported goods could actually lead to a decrease in demand for those huge cargo ships and the whole global delivery system that relies on them.
Interesting.
Right. But then he contrasts that with a potential future increase in demand for more local transportation, like trucking and railroads.
If domestic production ramps up because of the tariffs, you need more ways to move those goods around within the U.S., right?
Exactly. It's this complex web of potential changes, some immediate, some playing out over time.
Makes you realize just how interconnected everything is.
It really does. And speaking of interconnectedness, the report highlights a few specific areas that are really feeling the pain from these tariffs right now.
Like the car industry in Mexico.
Yep. They're in a tough spot because they rely so heavily on demand from the U.S. And with these tariffs, they'll likely have to pass those extra costs on to consumers.
Ouch. Not a good situation. And Bill even points out that countries that you might think are immune to this stuff, like Switzerland and Singapore, they're actually feeling the heat too.
Yeah, no one is truly isolated in today's global economy. He points out how these tariffs are actually increasing the chances of Switzerland having a weaker economic performance overall.
Wow.
And for Singapore, which is like a massive global hub for shipping, the potential impact is huge, especially if you factor in the possibility of even more retaliatory moves from countries like China and Japan.
Oof. So tariffs are definitely a major theme in this report, and not in a good way. But Bill also spends some time discussing something that's often overlooked, the role of emotions in the market.
Yeah, that's a crucial element.
And he kicks it off with a pretty blunt observation about how some investors just completely ignore prudent advice.
Yeah.
And the whole point of managing risk, they chase those high-risk trades and end up getting, as he puts it, steamrolled.
He's not pulling any punches.
Nope. And he's clearly pointing to those classic emotional drivers. Greed, fear of missing out, that whole thing.
Yep. It's a reminder that even the smartest investors can be swayed by emotions, especially in volatile markets.
The takeaway here is that emotions are a huge force in the market, often even more so than the actual fundamentals of companies. And that's where disciplined investors can really gain an edge.
Absolutely. Knowing how to control your emotions, not letting fear or greed dictate your moves, that's a powerful skill.
For sure. And Bill ties this whole emotional element directly back to that risk-off sentiment we were talking about earlier.
Right.
He actually defines it as a market sentiment that's driven by, and I quote, negative, fearful, and defensive attitudes.
So, not exactly optimism and sunshine, huh?
Definitely not. It's a stark reminder that market movements aren't always based on pure logic and cold, hard data.
Right. There's a whole human element at play.
And Bill gets even more specific when he brings this emotional element into the discussion of sector ETFs.
Interesting.
Yeah, he basically suggests that Wall Street sometimes uses these ETFs to, and I'm paraphrasing here, play on investors' greed and fear, ultimately leading them to make bad decisions.
It's a pretty cynical take, but I can see where he's coming from.
Right. Makes you think about how much we're influenced by the way financial products are packaged and presented to us.
Absolutely. And the narratives that are built around them.
Exactly. And the report also highlights the importance of something Bill calls emotional discipline.
Love that term.
Yeah, it's great. And he specifically talks about this in the context of trading commodities, warning against letting those wild price swings dictate your decisions.
Which is really tough, right? Commodities are notoriously volatile.
Oh, yeah. One minute you're up, the next you're down. Easy to get swept up in the emotional roller coaster.
For sure.
And he even uses this amazing metaphor describing investors' emotions as being suspended in continuous chaos.
It's like we're all just dangling in the wind.
Right. And he says they're being played almost like a musical instrument between greed and fear.
Wow, that's powerful imagery. Really captures the psychological ups and downs of the market.
Definitely. And then he touches on another fascinating concept, herd mentality. This idea that stock prices can be influenced just by what everyone else is doing, almost regardless of the actual underlying value of the companies.
Yeah, it's like the psychology of crowds. Everyone rushes for the exit at the same time, and suddenly you have a stampede, even if there's no real danger.
Right. So lots to unpack there. But to bring it back to Bill's report, he specifically mentions the expected avoidance of fear next week as something to watch, which seems to underline just how much fear is driving the market right now.
Yeah, fear is definitely the dominant emotion at the moment.
So after laying out all these themes and concerns, what's Bill's main takeaway? What does he think we should be doing?
Well, his conclusion is pretty bold. He flat out says that Trump has, and I quote, broken the global equity market.
Wow.
Yeah, strong words. And he believes this has pushed investors towards the perceived safety of government treasuries.
Makes sense. When things feel shaky, people want stability.
Right. And he actually reiterates his previous advice, which is to favor holding treasuries over stocks in the current climate.
So basically, buckle up and play it safe.
Pretty much. And he doubles down on this idea of the U.S. entering an age of austerity.
Yeah, that concept really stuck with me. What exactly does he mean by that?
He paints a picture of lower economic growth, tighter budgets, and overall a pretty significant shift from the boom times a lot of folks have gotten used to.
So not just a bump in the road, but a more fundamental change.
Exactly. And he suggests that average annual total returns might only be in the 5%, 7% range over the next 5 years.
That's a lot lower than what many investors are probably hoping for.
It is. It requires a real adjustment in expectations. But he does see potential opportunities within this new landscape. He thinks we might see a comeback of value investing, the kind that Warren Buffett is famous for.
Focusing on the solid, reliable companies that are trading at reasonable prices.
Yeah, the fundamentals. And he points to a few signals that support this idea of a shift in the market. He talks about a technical breakdown of the S&P 500 and how the Mag 7 stocks have taken a serious hit.
Those are the high-flying tech giants, right?
Exactly. And he believes this points to us potentially being in the second phase of a bear market.
So buckle up. Things could get bumpy.
Potentially. And Bill also issues a pretty strong warning about the risks of having too much of your portfolio concentrated in U.S. equities, and specifically stocks related to AI.
Which is where a lot of people have been piling in lately, right?
Right. So he's really emphasizing the need for diversification. Don't put all your eggs in one basket. And he seems pretty convinced that the recent rally in the market was just a temporary blip.
Not the start of a new bull run.
Nope. And he highlights the fact that the Dow 30 is now sitting right on its 50-day trend line, which he sees as a make-or-break point.
So we're at a crossroads.
In a way, yeah. And now, here's something interesting. Bill doesn't actually recommend ETFs.
Really? Why not? They're super popular.
His reasoning is actually Pretty straightforward. He wants to be able to look closely at each individual company within an investment, just like you'd inspect produce at the grocery store.
Okay, I like that analogy.
Right. He wants to make sure the companies are good quality, so to speak, and that they're priced attractively.
So when Bill talks about wanting to see the produce in an investment, he means he wants to know exactly which individual stocks are in his portfolio, right?
Yes, that's exactly. Unlike an ETF, which just bundles a whole bunch of stocks together. But he does find industry-specific ETFs useful, not as investments themselves, but as research tools. They help him get a sense of how different sectors are doing and identify potential opportunities or red flags for individual stocks within those sectors.
Okay, so it's more about the information they provide than actually investing in them directly.
Exactly. And while Bill's pretty cautious in the short term, he also mentions that his long-term outlook and his personal tolerance for risk are pretty high. And because of that, he sees potential in the fact that some commodity prices have been dropping.
So he's looking for those bargains.
Yeah, it's a reminder that different investors have different time frames and different comfort levels with risk. What looked scary to one person might look like a buying opportunity to another.
Definitely. And Bill doesn't hold back when it comes to his assessment of the Dow 30 blue chips. He calls what happened this past week a complete wipeout.
Ouch.
Yeah, not good. Very few companies showed any gains, and a lot of them have actually fallen into bear market territory. He even compares it to the Friday before the Black Monday crash in 1987.
Yikes. That's a pretty serious comparison.
Definitely meant to grab your attention. And he also points out a fascinating trend within the Dow 30, a shift towards more defensive stocks, specifically consumer staples like Coca-Cola.
Makes sense. When people are nervous, they tend to gravitate towards things they know and rely on. Coke is, well, Coke. People are still going to drink it, even if the economy's tanking.
Exactly. And for folks looking for income, he suggests that utility stocks might be a decent option because they often pay dividends.
Right. Those are companies that provide essential services like electricity or water, so they tend to be more stable.
But he does caution that utility stocks can be sensitive to rising interest rates.
Yeah, that's a good point. It's always a balancing act. No investment is perfect.
Right. It's all about understanding the trade-offs.
Absolutely. Now, in terms of Bill's personal investing strategy, he's actually decided to hit pause on focusing on his Cara 100 list.
That's his curated list of, recommended stocks, right?
Exactly. And he's shifting his attention to what he calls the Bill Cara Global Best 100 list, which is basically a watch list of companies that he thinks have strong potential.
So not buying them yet, just keeping an eye on them.
Right. And he plans to turn this list into an actual portfolio once the market downturn ends and stocks enter what he calls the accumulation zone.
Okay, so he's waiting for the right moment to strike.
Yep. And he has specific criteria for identifying that moment. He uses technical indicators, specifically the RSI and MACD.
Those are tools that help investors gauge momentum and try to predict potential trend reversals in stock prices, right?
Exactly. So he's combining his fundamental analysis of companies with technical analysis of their stock prices to find those optimal buying opportunities.
So a very data-driven approach.
It is. And he also emphasizes his core investment principles, which are pretty solid. He prioritizes understanding the actual fundamentals of a business, staying away from speculative bets, and maintaining a diversified portfolio.
Don't put all your eggs in one basket.
Exactly. And then, of course, he layers in those RSI and MACD indicators to help with timing. When to buy, when to sell.
Sounds like a pretty well-rounded approach.
It does. And he also makes an interesting observation, saying that, and I quote, "Nobody was making income this week from the income stocks."
Which just goes to show how widespread the weakness in the market is right now.
Yeah, even those typically reliable income-generating investments are struggling.
Not a good sign.
He also advises being very cautious about trading options, like puts and calls, especially late in the bull market.
Because things can turn south quickly.
Exactly. High risk of getting burned.
But it wasn't all doom and gloom, was it? Bill did highlight some bright spots.
Right. He points out the strong gains that bond funds saw this week, which makes sense given the whole flight to safety we were talking about earlier.
People moving their money into those more stable assets.
Yep. And he also takes another jab at mutual funds and ETFs, which he's been critical of in the past.
He sees them as products that are more sold than bought.
Right. He thinks they often come with high fees and can underperform compared to a carefully selected portfolio of individual stocks.
So do your research, pick your own stocks. Don't just blindly follow the ETF herd.
That's Bill's philosophy for sure. And zooming out a bit geographically, he emphasizes just how much Canada and Mexico rely on trade with the U.S. He suggests that investors need to be super cautious in those markets right now, given the potential for serious negative fallout from a full-blown trade war.
Yeah, those economies are pretty intertwined.
They are. And he specifically highlights the pain being felt in Mexico's auto sector and the volatility of the peso, which kind of weakens the whole argument for nearshoring.
Which is the idea of moving production closer to home to avoid those global trade headaches.
Exactly. So even that strategy might not be as foolproof as some people thought.
Interesting. And what about other parts of the world? Any specific recommendations?
Yeah, he suggests being underweight in Germany, which basically means reducing exposure to that market.
Because of their reliance on manufacturing and exports.
Right. He points to the contraction in their auto industry and the broader manufacturing sector as warning signs. He suggests focusing on more resilient domestic service industries there, if you do invest. And for Hong Kong and China, his stance is definitely cautious.
Because of the tariffs and, well, the whole geopolitical situation.
It's a double whammy. He's keeping a close eye on how vulnerable their exporters are and the potential for the Chinese government to step in and try to manipulate the markets.
Always a wild card.
It is. And as we look ahead to next week, Bill highlights a few key things to watch.
What's on his radar?
Well, obviously those weak stock prices. That's still a major concern. He's also watching to see if that fear starts to subside at all and how consumers are handling the pressure of inflation.
Makes sense.
Plus, he's keeping an eye on the impact of those rising commodity prices, which can have ripple effects throughout the economy. But here's the interesting thing. Even with his overall cautious outlook, he does see some potential bright spots.
Oh.
He thinks certain areas of tech, specifically AI and gaming, could see some growth even in this environment. And he's also bullish on the defense sector, particularly European companies like Airbus and Saab.
So even amidst all the uncertainty, there are still opportunities out there.
Always.
Well, this has been a really insightful deep dive into Bill Cara's latest report. It's packed with information, and he's clearly grappling with a very complex and, frankly, unsettling market landscape.
Totally agree. It's a lot to process.
And we just want to say a huge thank you to Bill Cara for putting together such a detailed report and especially for making it freely available during these crazy times. The insights he provides are incredibly valuable.
Couldn't agree more. He's doing a real service to the investment community.
Absolutely. So if you're interested in following Bill's analysis directly, definitely go check out his website, billcara.com. That's billcara.com.
And don't forget to subscribe to NotYourAdvisor.com for more deep dives in independent financial insights. We're here to help you make sense of it all.
All right, so let's do a quick recap of the key takeaways from Bill's report. The biggest themes that keep popping up are the huge impact of those U.S. tariffs, the widespread risk-off sentiment driven by those recession worries, and Bill's overall cautious but insightful perspective on where we stand in the market right now.
Right. The markets are always dynamic and things can change rapidly, which makes it even more important to stay informed and be smart about how you manage risk. Bill's report really drives that point home.
It does. And it leaves us with a lot to think about, doesn't it? Given this whole age of austerity idea and the renewed focus on value investing, what sectors or even specific companies might be flying under the radar right now? What opportunities are out there that maybe we're not even seeing yet?
That's the million-dollar question. And maybe even more important, how do we cultivate that emotional discipline that Bill talks about so we can make smart, rational decisions, even when the market feels like it's going haywire? It's a real challenge.
Definitely. This report really makes you think about the long-term implications of what's happening in the world and how interconnected it all is.
For sure. We're all in this together, whether we like it or not.
All right, folks, that's it for this week's Deep Dive. As always, thanks for tuning in, and we'll catch you next time.
See you then.